Hello, everyone. Good afternoon. Really excited to be here to moderate this panel on how technology is reshaping private markets. I just want to quickly start with a quick fact and just to give a quick idea on the magnitude of the discussion we are going to have. So, if we talk about private markets, in just last one decade, it has become three times. We're talking about 13 trillion in 2013, sorry, 4 trillion in 2013 to 13 trillion now. And it is also estimated to surpass 40 trillion. So if you see, it's a very upward curve in private markets. But at the same time, the technology is also growing at the same pace. We are few years ago, we were just talking about blockchain, which are very early stage, early experimentation is going on. Soon enough, AI joined the mainstream. And if we just compare last decade to this decade, the technology front face looks very different. So with that context, I just want to start this conversation, which is bringing these two growth curves together. I want to just start with a quick introduction of the panel. Stephanie, you want a quick start?
Thanks, Risha. Good morning, everybody. My name is Stephanie Ramazan. I'm founder and CEO of the Crypto Collective. We are the world's first growth, strategy, and communications consultancy focused purely on institutional crypto. What does that mean? We work with traditional banks, funds, asset managers coming into the space, but we also work with crypto native firms across all things growth and strategy and also PR and communications. Our clients span from infrastructure providers, such as staking, to my good friend Mark on the end, he'll tell you what he does. But like I said, we are purely institutional crypto, but we cover the whole spectrum.
Hello, I'm Dennis Crisallo. I'm the head of asset and wealth management for a group called Connexus. This is JP Morgan's blockchain business unit. We have a number of different applications, including one we launched last week, which is our alternative investment fund tokenization platform called Connexus Fund Flow. And I've been in the space or in the alternatives business for about 10 years, building and delivering portfolios of hedge funds, private credit funds, and co-investments.
Hi, everyone. My name is Ivan Mihov. I'm the Chief Revenue Officer for Boltzbit. We're a deep tech AI company delivering custom large language models via a full stack no-code platform, the result of which is completely private, proprietary trained large language models for any organization. We're also doing a lot of research in the space, pioneering new transformer architectures with online learning capabilities.
Hi, everyone. My name is Mark Faubeau. I'm founder and CEO of Tradeit. First of all, it's a pleasure to be here today. Tradeit is a private credit marketplace. We're leveraging blockchain and AI as infrastructure only. So we remove the barriers to entry and the headache to understand and know about the technology. The idea for us is to bring more liquidity into private credit, reduce the cost of capital, leveraging blockchain, and reduce the time it takes to do due diligence on private credit deals.
Thank you, everyone. So quick, I want to start with Ivan. Do you want to quickly cover or just do you want to start the discussion on, even though private market is showing so much growth, if we compare to public market, it's still not there. So do you want to throw some light on where we are exactly, especially in technology adoption?
Excellent question. For the record, I'll speak on behalf of Boltzbit as an AI company, and I think my colleague panelists will add from the blockchain perspective. Private markets are private. What does that mean? The data is private, the relationships are private, the deals are private, and the liquidity in that market is also very private. Therefore, generative AI, large language models utilized to service the industry and service the asset class are very much hitting a scaling limit because large language models have been trained on public data rather than proprietary data. And that prevents from the technology to really take off in something that relies on so much proprietary information. If you look at the full data lifecycle of data extraction leading to insights, leading to predictions, I would say private markets are somewhere between data extraction and analytics, and we're yet to see the technology being applied in predictive analytics, aka running your risk credit engines and predict and score counterparties. So on the data extraction side, the examples we had earlier and what we've seen on the market is people using the technology on a one-off basis. We have not seen a systematic data extraction pipeline in private credit markets. Why? Because public large language models do not know the data. They do not know the workflows that's private to firms and individuals is per se. And with regards to analytics and insights, and there were quite a few panels this morning that gave a lot of insight into it, people using large language models for personal productivity tools. Yes, you can look into the data, get the insights, visualize the data, but that's still on a one-off basis through chatbots. So there is no systematic application of the technology that can essentially build data extraction pipelines that feed into automation processes for due diligence and client onboarding, which naturally will accelerate the liquidity that's coming into those markets.
Thank you so much. That was data perspective. Stephanie, you want to add more to that one?
Sure. I think taking a step back, if we focus on the blockchain piece, whether it's private or public markets, there's still a lot of fear and a lot of education that needs to be done around sort of real risks versus perceived risks. And for me, just focusing on blockchain, I think the big shift will come when there are more and more platforms, businesses out there that are using blockchain, but the end user, whether that's an institution or a retail user, won't even necessarily know that blockchain is part of the equation. Mark will tell you more, but what he's doing with Treddit, the blockchain piece is just enabling him to disrupt a multi-trillion-dollar market. It's not about the blockchain tail wagging the dog, so to speak.
Okay, so that's the best segue. Mark, you want to throw more light on how blockchain can really help the private markets?
So before building Treddit, we looked at the market and we observed that today the technology is being force-fed to the industry. So when you talk about private markets, whether it's private equity or private credit, these are very niche markets. It's a market that has been there for some time and requires a lot of skills. So as soon as you want to touch this type of market and you come saying, hey, we've got this blockchain product, you have to invest using stable coins and you have to do X, Y, Z with blockchain, you're losing 99% of your audience and your target. So what we developed is a fiat in, fiat out model. It's infrastructure only, whether it is on the blockchain front or the AI. And it removes the need to know about the technology. Like when we went from fax machines to emails, no one taught you exactly how an email is actually working. They told you about the benefits of an email. And that's very much with this type of mindset that we've been building Treddit. So how do you build something today that can be integrated seamlessly into the existing frameworks without pushing your users to have to know what is a stablecoin, how to get access to a stablecoin, what is a CEX, a DEX, etc. And this is one of the opportunities that we see today, is really much reviewing how we talk about blockchain, or not even talking about blockchain at all in the first place.
Yeah, I would maybe just add on to what everyone's saying. Within the private market space and the alt space overall, I think the issue that everyone's kind of getting at is around distribution. Institutions are largely filled up of alternative allocations at this point. And so you see all the large investment houses trying to better access individual investors who are woefully underallocated to private markets and to alternatives overall. And so what we're looking at, I think some of the co-panelists are looking at as well, are different ways to use this technology, whether it's AI, whether it's blockchain and instant settlement, to better distribute and service these products. How do you enable folks to more easily fund capital calls, enable better data management by using this kind of technology so that ultimately it becomes pretty seamless to be able to have that 20% alt allocation and improve the end investor's portfolio?
And do you want to add some specific use cases where you have seen success? Maybe you and Stephanie, you as well.
Yeah, sure. So I think like when we think about use cases and tokenizing assets, there's kind of two different flavors at this point. One is around taking a traditional investment or traditional assets in the sense of, you know, whether it's a money market fund or kind of like a vanilla private equity fund, and using public blockchain rails as a distribution mechanism to bring that asset to folks with dollars already in the blockchain crypto ecosystem. That's kind of one flavor of it. And then the other side of it is taking blockchain and crypto technology and bringing that to a more traditional investor base, which from our perspective, these things will converge, and it's important to play in kind of both sides of this barbell that I've described. But we think the total addressable market on using blockchain technology for delivering product to investors, how they're used to consuming it, whether that's through an RA, a wealth management platform, et cetera, is a pretty meaningful way to kind of go about this issue. And so, when we think about like the key issues of delivering alternatives, it's really around data management, where you have just very poor data sharing amongst fund managers, distributors, and fund administrators. And then two, that's compounded by just the challenge of moving a dollar from a client account to a fund manager. Today, it's generally accomplished with wires, sometimes bundled together. But when you multiply that by 2,000 investors in a given fund, it becomes very laborious to kind of deliver these products to your clients. And so, again, using blockchain instant settlement abilities to move a tokenized dollar to a fund manager as opposed to sending a wire is going to lead to tremendous benefits and scale.
Stephanie, want to add?
I will zoom right in on one particular asset and use case that I've been very close to over the last 6 months through a client of mine who has tokenized physical spot uranium. Fairly provocative subjects for obvious reasons, but I think this was a really interesting and almost perfect use case of RWA tokenization. Tokenization and RWAs have been talked about for years, but I think 2025, first of all, has been a year where we've seen a lot of progress and real progress. But I think it's about showing the power of the technology to actually unlock asset classes that before were very, very much off limits, not because of market need, demand, and uranium really was one of those perfect use cases for that. So I'm sure there are commodities experts in the room, but just at a high level, some facts for you. The minimum tickets to trade spot physical uranium, somewhere around $4 million. Now with tokenization, anybody can access that from a few dollars. You can do this from a centralized exchange, or you can do this via the client's own website, uranium.io. But the really exciting piece for me are the partnerships that are in the pipeline with traditional platforms where they want to list this uranium token, but it won't be listed next to, say, next to Bitcoin and ETH. It will be next to silver, gold, palladium. So it's just, as we were going back to, it's those rails, the underlying rails that opens up access to markets that otherwise were reserved for very, very large institutions. Uranium has very, very poor liquidity, very bad price transparency. There is an ETF, but again, the pricing is a little bit esoteric, to say the very least. So we're really seeing demand for other metals and other commodities to be tokenized in this same way.
This is a really interesting use case. Mark, you want to add some use?
Build up on that. So as Stephanie rightly mentioned, there's this need of better accessibility. Speaking mainly about private credit here, where we use blockchain is to reduce the cost of capital. Because when you look at private debt today, there's a lot of intermediaries. You've got settlement agents, transfer agents, bookkeepers, arrangers. There's a whole list of service providers who take the fee while you just structure the product. So today, to give you an idea, structuring debt is 1.5 up to 3%, sometimes a bit more, of the nominal value of your debt. That's just structuring, that's just creating the product. Then on top of that, for a borrower, you would have the interest rate, and private credit funds would take an additional spread on top of the interest rate. So we are focusing on mid-market companies. So these companies would be companies who are in Series A, Series B area. They've got 3 to 5 years of track record, recurring revenue, and they've got a need in working capitals of like 10 to 100 millions. If you do the math, if you've got up to 3% just to structure the debt, and then you've got this 7 to sometimes mid-teens interest rate, plus on top of that, you've got a spread taken by the private credit. That's a lot of money for most of the companies, for most of the mid-market SMEs. And this is not viable. So when you're above the 100 mil mark, that's fine. But that's where with blockchain, you don't need settlement agent. It's settled directly on the blockchain. You don't need bookkeepers. It's directly recorded on chain. There's a lot of things that also smart contracts, which are self-executing contracts and technically algorithms can replace. It goes into loan terms that can be automated. So obviously there will always be the need of like having a bit of human reviews and making sure that, you know, the tech is going in the right direction. But when you combine that with AI, this gets more powerful than a lot of people today in the industry want to recognize. When we speak to some private credit fund, they're like, well, you cannot replace us. In a few years' time, yes, the AI is that powerful that an analysis is going to be able to do a better job than human being. And this is where, what do we want to do today with it? How do we guide this evolution? And this is, I think, what we are all working on today on this panel.
Yeah.
Make a point. Very fine observation on the infrastructure that everyone is building and working towards being able to supercharge the process and reduce the costs for structuring the credit. Now, that infrastructure, be it blockchain or something else around that, cannot be built by AI, right? Because humans need to design in anticipation of what the market might look like and how the market should behave and how access and liquidity should be democratized and so on. However, infrastructure needs to be fed data. And where the data is coming from is the critical part here, which I would like to allude on, is data is unstructured and is slow to arrive in the models and is slow to hit the infrastructure. So this is where AI comes into play, especially around the due diligence process and customer onboarding, reviewing documentation, extracting data, normalizing it. So those are two critical parts that I would say would overlap to some extent, but they connect seamlessly. AI will not do blockchain, and blockchain can probably not build large language models. Of course, you can run LLMs on blockchain, you can tokenize the LLMs, but that's just a big pie in the sky right now that we're not touching. But yeah, very fair point.
Yeah, I would just add to private credit specifically, it is a very well-suited asset class for blockchain and for smart contracts because you know what payments have to be made, you know what maturities are. It's very rules-based, including when you start to securitize and structure these particular assets. And then when you also bring on the element of the servicing of the underlying debt onto a blockchain network, now we're talking about something that's entirely different and gives you arguably a different risk-return profile because now you have this brilliant transparency into how the underlying loans are actually aging, how they're being paid down, which you don't get today from a private credit manager.
Fantastic. I think that's the beauty of this particular discussion we are having. We are not talking about only blockchain. We are not talking about only AI, but we are really talking about how everything is coming together. So before we dial down a little bit further in AI space, I just want to recap a couple of things. So data management is one of the issues you spoke about. We're talking about smart contracts and the workflow efficiency we are talking about, the structuring of fund we are talking about, and how AI and blockchain can complement each other. And of course, the uranium story. I think this is one of the most innovative things I have heard recently in the blockchain space. Now, if I go dial down more into AI, Ivan, you want to start on more into the light of AI. We spoke about AI along with blockchain, but AI by itself, what is the future in the private markets?
I would like to probably start with something else, is what AI cannot solve these days, especially in the private credit markets. And as I said earlier, infrastructure and the anticipation of efficiencies around infrastructure, data ownership and processes is one thing. Second, and you mentioned that earlier, there are a lot of rule-based processes in place. So why do we need AI agents for something that's rules-based and it's probably running way more efficiently? So I would say that there is a lot of over-identification of simple processes that are monolithic and solid and that do the job very well, just for the sake of hyping up the role of the agent. And at the end of the day, an agent is just a way to automate a tool to access data. But we've had robotic automation for many, many, many years. The key is the model and the quality of the model that those agents are using. So I think the future of any AI applications, not only in the private markets domain, is the ownership of those models. the understanding of market participants, what those models are capable of doing, and the confidence that the models are trained on the right type of data. Obviously, reducing hallucinations and increasing performance is important, but if your model architecture and the data you're feeding it are irrelevant, so would the output be. The second part, and again, that speaks to the future of where AI will progress in the coming months. I'm not saying years because the space is moving super fast for us to be talking in years, is the ability for models to adapt in real time on new data and new information coming in. So far, what we've experienced on the market is AGI 1.0, if I can describe it this way, which is pre-training large language models on data and then using chat to retrieve that data. Those models are static. AGI 2.0 might be defined by the ability of those models to learn new information in real time, learning by not retaining it into context, but actually embedding it in the model's memory. So for example, if a new information for a new deal comes along, the model is able to process it and learn that. The models will also be able to anticipate in the private credit markets domain what new deals might be coming to the market before the humans have even thought about it. That does not mean that AI will eliminate the intent of investors, of customers, of platform participants, but it can help navigate in advance. And I think this is a very underutilized area of the application of transformers and large language models to predict. And again, you might argue, well, we've had machine learning for so many years, we've been doing predictions. We're moving away from hard-coded machine learning to super flexible online learning capabilities of new technology that I like to think more as machine learning 3.0 rather than agents.
Very interesting take on AI. Mark, you want to add further on that one?
So on the AI front, and again, specifically on the credit side, is the due diligence process obviously is very painful. You look at 3 to 6 months on average. And the one interesting stat is it actually takes, according to research, 100 hours to complete the due diligence as per private equity or private credit standards. So where are those 100 hours actually going? They go in wasting time sending emails, looking at PDFs, looking at Excel spreadsheets, calculating some formulas, looking at the exact figure that you're looking into your financials and your invoices and et cetera, et cetera. Nothing that the AI can actually help to speed up. So this is where we see the added value of leveraging AI, and this is why we're partnering with Boltzbits and Ivan's team, is how to create more liquidity in private markets, because that's a very big issue. In private credit, you've got 5, 7, 10 years of lockdown periods. So your investors, your seed investors cannot get their money out. Whoever is going to originate the debt to start with, whenever they want to get out of this transaction and they go to a secondary buyer, the buyer is going to be asking, what do you know that I don't know? Am I buying into a toxic asset? Why would I buy this asset from you? So they would ask a discount. And at this stage, it's better most of the time to buy and hold. So by removing the asymmetry, lowering the asymmetry of information, making it clearer, so cleaning the data, making sure that it's uploaded properly, it's going through LLM, so you can directly spot what is good, what is not good, and if it's not good, then you can focus on the gems, like the right product, the right investment that would be good for your company and your investment portfolio, and reducing this time from 3-6 months to weeks to days to potentially a few hours in the future. So it's not here honestly to replace due diligence, but it's here to filter out the bad eggs technically, so you can focus and do your enhanced due diligence, and those 100 hours of due deal, actually having them a lot closer and not spread out over 3 to 6 months.
And just to add to that point, we both worked in the secondary market in traditional finance, and we know how long it took to onboard our clients back in the days. And again, that's foregone revenue and opportunity. And what we also learned from secondary markets, especially in the OTC asset classes, is that liquidity is temporal, meaning it's there when you probe it. It might not be there when you actually need it. So reducing the time it takes to onboard and increasing that speed and velocity of getting customers into the platform, introducing companies to investors, actually delivers the liquidity needed.
I mean, being from secondaries market, I can completely vouch for that. I think we, just in interest of time, we did touch base on different barriers throughout the discussion so far. Like, you know, I just want to say, is there any barrier to the technology adoption which we haven't discussed yet? We want to, Dalton, Dennis, you want to start?
Yeah, sure. So I think it starts first and foremost with what asset you're referring to and what use case you're looking at. And just from our world, we kind of break things down into public chain use cases and private chain use cases. And so today, if you want to own or transact or interact with assets on a public blockchain, you need to be fairly savvy, right? You need to be able to understand how to use wallets, what different types of transactions mean. You have to have, funds in there to pay gas, depending on what chain you're working on. It's just a different experience that a lot of institutional and individual investors who are more nascent to the space are frankly afraid of. That may change with regulation and with special purpose broker-dealer rules coming into play where the providers can abstract more of that away or hide the wires. We could already do that on the private permission blockchain side, which is primarily what we run on today, but not entirely. And so there, the experience is largely that hidden wires experience where investors don't have to bring their own wallet. They don't have to interact with the blockchain directly at all. All of that's taken care of through like a key management system or, a wallet vendor, et cetera. And so, like one of the big barriers is just getting comfort and education with what you're actually getting into and what those new incremental risks look like. But then you also have, just like internal barriers around how do you convince your stakeholders that it's even worth it to go down this path. And so there you have to recenter around what the value add is for what you're participating in. If it's tokenized alternatives, is it streamlined processes, easier cash movement, better interactions amongst assets. And if you're dealing with more public chain assets, this is primarily around being able to access products that you can't today. So in the case of like a money market fund and earning that relatively risk-free or riskless yield, you have to be comfortable holding those assets on the public chain and everything that comes along with that. What I will say is usually not the barrier, is the technology itself. The idea of like being able to represent an asset in token form is quickly becoming a commodity. It's a problem that's been solved. There's of course bells and whistles which are being added by the industry, but it's usually not a technological barrier. It's more of an education, comfort, and risk and control barrier.
Do people actually care about how the technology works, like the very inner workings of the technology, or they care more about how do we work with the technology, right? Because they're two different levels.
No, it's a great question. It's something that me and my colleagues talk about a lot. Is last cycle there was much more emphasis around how does this actually work? Like what does it mean to hash something? How do the wallets like infrastructure come together? How's my public key derived? All those kinds of things. Today, it's less about that and more about why am I doing this and like how does this help me?
And I think from the crypto blockchain, no secret, it's got a fairly mixed reputation. So there's still this major fear factor. So I think people do care a bit more about how is this working, because only through education are we going to get that broader adoption. AI seems to have that lower barrier to entry, maybe because everyone loves ChatGPT and your regular person on the street thinks AI is ChatGPT and that's where it starts and ends. Not about the huge ecosystem that's out there. So I'd say it's mixed and it depends who your end user is from my perspective.
And yet no one knows how it works, right? I mean, even researchers in the space don't know how it works. But I think the level of comprehension is getting there, but there's still very large technical barrier to engineering your own models. It literally is rocket science. Someone asked me before, like, oh, truly, like, not just a handful of people can do it. Actually, only a handful of people can train and engineer new models. So that's like, we're at the stage where we're building rockets right now, probably like similar to what we did 100 years ago, and we're still launching them and crashing them and trying to figure out the best propulsion system for this thing to leave our backyard of experimentation, right? That's the state of AI right now, and there is so much information and people are just struggling to catch up with it. I think the mindset is there. We were discussing earlier in preparation for that panel, like, is it a mindset problem or not? I think we're well beyond this point, both with blockchain and with OpenAI. People know they have to use the technology and they're willing to invest into it. but at least in the AI space, everything is still in a very early MVP stage, and moving from MVP or POCs into production takes a lot more effort. An example in data extraction, right? If you rely on, if your business relies on perfectly extracted data, the difference in accuracy is single digits, right? The difference in productionizing something can be 90%, 97% accurate to 99.5. If you scale that to 1 billion type of transactions, that adds up pretty quickly, right? And this is where the true engineering shines in that sort of last stretch.
That's actually a very, very good point. And we can actually talk hours and hours on that particular topic. And that's the fear of many of the stakeholders. But I would just add one point with my own experience in the AI space. I have seen is like earlier, we had to do a lot of convincing to stakeholders to be open for new technology. It could be the ChatGPT effect, but people are much more open to at least having the conversation to try out the new technology, either blockchain. Blockchain, I still feel like there is up and down. I keep hearing on my side, but AI, it's just the whole hype cycle we are going through. Stakeholders a little bit more open.
Yeah, no, I think that resonates with me. Like, if you compare like a ChatGPT output versus going on a Block Explorer, it's a very different experience as far as understandability.
That's so true. That's so true. Okay, so just we are towards the end of the panel. I just want to leave the forum open. Any closing remark, or where do you see the the private markets is heading for technology adoption? Stephanie, you want to start?
The possibilities are obviously endless. How quickly we get there is another question. But I think we just need more of the same momentum that we've had, especially this year. I was having a meeting with a very large institution a couple of weeks ago, and the age-old expression, how does it make me money or how does it save me money, came through. And I think that's, applications of both AI and blockchain can do both. Going back to what we already said, there's a lot of education still to be had, but I think that transition will come sooner than people think. We have updates on our iPhones, our Androids overnight. Some of those apps are updating and will be blockchain-based rails within those apps. So it's coming back to that point of, do we need to know? Do we really care? We just want things to work to the best of their ability. So as long as we keep giving people, both retail, institutional, the technology that they need to enable what they need to do, hopefully no more black swan events in the crypto market that sets everybody back a little bit. But we've all grown up a lot since then. So I think just more of the same.
No, that's great. And I'm also seeing is like how literacy program in technology space is becoming such a front line. So completely agree to that.
Yeah, maybe I'll just share something I'm excited about, which is when we look at blockchain and really the superpower here of tokenization, it's this ability to represent multiple types of assets in the same set of infrastructure. What that means is that I think we're just scratching the surface as far as the types of interactions that you could enable amongst assets. And so the things that we think about and we're trying to build towards are portfolios of tokenized assets, whether they're private assets, whether they're ETFs, money market funds, whatever. And then also looking at how we can connect liquid assets with illiquid assets. And so imagine, you have a portfolio of, 60-40 funds and money market funds, and you have capital calls coming in constantly. How do you seamlessly enable the redemption of those liquid assets to fund the capital calls without you having to do anything? And with basically eliminating the opportunity costs and cash drag from managing a portfolio, which anybody who manages a portfolio, that's just part of the game. So that's what we're excited about.
Wow, interesting.
Private credit, in my opinion, is the asset class that can benefit the most from new technology, be it blockchain or AI. And from where I'm standing, and I'm not a blockchain expert, I think blockchain is having its cloud moment in the private market space, where I think in a few months' time, or maybe less, you go and say, "Wow, the solution is blockchain native," and people will be like, "Yeah, I mean that's the standard we expect to see." The same way you say we're cloud native now, and no one bothers because everything is cloud native. I think AI is probably like 2 steps behind, where people say everything is AI native, and people still get impressed, but it's still trailing the blockchain adoption by, I wanted to say a couple of years, but because AI is moving so fast, probably like 6 months' time.
And I'll leave you with some numbers. I like my reading. By 2048, there's going to be 124 trillion of wealth that is going from hands to hands. The new generation, whether it's family offices or new generation of managers at asset management companies, etc., and so on, They were high on dopamine. They understand tech. They want everything fast and sometimes lazier than the older generation. So how do you get them to take over without doing too many, mistakes? And this is where AI and tech and blockchain is going to help. You've got in 2025, 32% of the family offices that have been surveyed want to invest in private credit. 63% of the institutional asset investors have been increasing their allocation to private credit. So there's more and more capital flowing into private markets, yet it's still, bottlenecked by data management and due diligence and all the things that finally we've got the tools to solve.
This is great. We are at the end of the panel, and thank you so much. I think we had a great discussion, and thank you for all the inputs.
Thank you, Richa.